Your Estonian OU is live. Stripe is connected, clients are paying, developers are shipping. For a few months, accounting is just a folder in Google Drive called Invoices Later. Then three things happen at once. Your accountant asks for trial balances and source documents. The tax board sends you a polite reminder about a deadline you did not know existed, and an investor emails, "Can you send us your last 2 annual reports and a breakdown of recurring revenue?" That is the moment a lot of founders realize Estonia is fantastic for digital company setup and flexible tax, but it is not a no accounting jurisdiction. The system expects proper books, real reports and numbers you can defend. Welcome to Icon Partners channel, the place where we help you to understand everything about how the business world operates. In this video, we are going to talk about accounting and reporting for tech companies in Estonia, what every OU is actually obliged to do, what is different if you are running SaaS, dev, or product companies, and how to set things up so that you are ready for both the tax board and investors. On this channel, we already have separate episodes about setting up an Estonian company, about banking, and about relocating there as a founder. Here we focus on one thing. Once the company exists, what does doing accounting properly actually mean in Estonia? We will go through the core obligations that every company has, the recurring reports that affect your cash flow, and the specific traps that tech businesses fall into much more often than classic trading companies. Estonia is very digital, but in accounting it is also quite conservative in a good way. Every company has to keep proper double entry books. Transactions have to be documented. Financial statements are prepared on an accrual basis, not as money in the account. You can use Estonian GAAP or, for larger groups, international standards like IFRS. For most early-stage tech companies, Estonian GAAP is completely fine and flexible enough to deal with subscriptions, development costs, and equity instruments. 2 institutions matter for you. The commercial register cares about your annual report and about the formal side of your accounts. The tax board cares about the tax consequences, VAT, payroll, and corporate tax when you move money out of the company. Your accountant stands in the middle, translating your messy reality into numbers both of them understand. Let's start with the one obligation every Estonian company has, no matter how small it is, the annual report. Once a year, after the end of your financial year, your books have to be closed and your management board has to approve a set of financial statements. Those statements go to the commercial register in a standard electronic format. They become an official public snapshot of your company. For micro and small companies, the format can be very simple. Balance sheet, income statement, and a few notes. But simple does not mean sloppy. The numbers have to match your bookkeeping and they have to reflect reality. Revenue when it is earned, not when you feel like showing it. Expenses when they are incurred, not just when the invoice got lost and then suddenly found. If your company grows beyond the micro and small categories, or if you take on certain types of financing, an audit or at least a limited review may become mandatory. That is a separate project with independent auditors who will test your books, look at contracts, and ask questions that are very unfriendly to guesswork. All of this means that the "we'll fix it at the end of the year" approach works only once, and even then usually badly. Alongside the annual report, there is a rhythm of recurring reports that directly touch your cash. If your company is registered for VAT, you have regular returns. For many tech companies, this means reporting sales inside Estonia, cross-border services inside the EU, and sometimes non-EU exports. Even if the net VAT you pay is 0 because most clients are businesses, you still have to file the return. If you have employees in Estonia, you have payroll reporting. Salaries, social tax, and other contributions are calculated and reported on a regular monthly cycle. For remote teams, you also have to decide who is truly your employee under Estonian law and who is a contractor elsewhere with their own local obligations. Corporate income tax in Estonia is triggered by distributions and certain profit-like payments. When you pay dividends or distribute profit in other forms, the tax on that distribution has to be calculated and declared. It is not a tax you can just remember to pay later. It is linked to specific transactions. These reports are all built on top of your bookkeeping. If your books are late or incomplete, your VAT, payroll, and tax filings will also be late or incomplete. That is why good Estonian accountants obsess about having all invoices and bank statements on time. It is not perfectionism, it is survival. Now, how is this different if you are running a tech company rather than a small shop or a traditional service firm? First, revenue. Subscription and recurring revenue models are normal in Estonia, but they require proper recognition policies. If you sell an annual plan and collect the cash today, you cannot simply book everything as this month's income. Part of it is deferred and has to be released over the life of the contract. Investors will ask about monthly recurring revenue and churn. The tax board will look at whether declared income matches what really happened in the business. Second, development costs and intellectual property. A lot of the money you spend will go into building something that will generate revenue later: software, platforms, databases. You need a clear policy for when you expense that development and when you capitalize it as an intangible asset that is amortized over time. Get this wrong, and your profit and balance sheet will swing wildly from year to year. Third, equity and incentives. Option pools, convertible instruments, and founder loans are normal in tech, but they do not exist off balance sheet. They need to be documented and reflected in your accounts. A future due diligence will look at whether your cap table and your accounting tell the same story. Fourth, cross-border reality. Tech companies almost always have clients, contractors, or group entities in multiple countries. That means intercompany agreements, transfer pricing logic, and proper invoices between your Estonian company and other parts of the group. We'll just move some money when needed is not a strategy that survives for long in an audited environment. There are a few patterns we see again and again with early-stage Estonian tech companies. One is treating the company bank account as a personal wallet, mixing founder spending and company expenses, paying for personal subscriptions from the OU, and fixing it later. Later usually means a messy reconciliation that nobody enjoys and sometimes unexpected taxable distributions. Another is ignoring accruals. Founders book whatever is on the bank statement as revenue and costs without thinking about when the service was actually delivered or when the obligation really arose. The first serious investor, auditor, or buyer will immediately ask for numbers on an accrual basis and for explanations of large swings. A third is underestimating documentation. Verbal agreements with key contractors or standard terms with customers that exist only in email threads make it very hard to support your numbers when somebody outside the company needs to trust them. And a fourth is leaving accounting completely to a generic low-cost provider who has never seen a SaaS or product company before. They will happily book everything somewhere just to close the month, but they will not structure your chart of accounts, separate recurring from non-recurring revenue, or think about what an investor wants to see. So what does a healthy accounting and reporting setup look like for a tech company in Estonia? You have a bookkeeping system that is connected to your bank accounts and main payment providers, so transactions flow in automatically and are coded consistently. You have a simple but clear revenue recognition policy that reflects how your product and contracts actually work. Your development costs and IP investments are tracked separately, so you can see how much you are really putting into the product. Your board gets regular management reports that are consistent with what you will later file with the register and the tax authorities. When you are asked for numbers, you do not need a special investor version of reality. And your accountant talks not just about deadlines, but about how your structure, banking, transfer pricing, and future plans interact with the numbers. If you're thinking, I chose Estonia because it's clean and predictable, I just need my numbers to be the same, then getting accounting and reporting right is not optional. It is part of what makes the jurisdiction work for you. In other episodes, we talk about Estonian company setup, banking, and relocation. In future videos, we will walk through concrete reporting templates for SaaS, agencies, and product companies, and show how they plug into different international structures. If you would like to discuss what a sane accounting setup for your Estonian tech company could look like, you will find our contact details and a short intake questionnaire in the description. Thanks for watching, and see you in the next episode.